Hey everyone, and welcome to This Explainer. Today, we are tracking the journey of wealth. We all use money every single day, but how we understand it actually changes a lot as we grow. So, we are going to explore how to build wealth. We will start small with your own wallet, and then we will zoom all the way out to the entire world. So, how do we grow our wealth? It sounds like a super simple question, right? But the answer completely changes when we look at ourselves, then at our businesses, and finally at our society. It is really not just about saving cash in a bank. It is about how money actually works in the real world. Here is our agenda for today. First, keep your money simple. Second, winning the loser's game. Third, what makes companies strong. Then, the growing wealth gap. And lastly, invest to fix society. We've got a lot of ground to cover, from personal finance all the way to fighting national poverty. Let's jump right in.
Section 1. Keep your money simple. We have to start with your own money. Before we can go out and help the world, we absolutely need to build a strong base for ourselves.
Authors Hajime Yamazaki and Takaro Morinaga share 3 very simple rules to protect your wealth. First, avoid financial salespeople. They usually work for their own profit, not yours. Second, buy index funds. And third, don't rush into real estate. Keep your choices incredibly simple. These basic rules are going to protect you from getting bad advice. Let's look a bit closer at rule number 2. What exactly is an index fund? Well, it is just a low-cost way to invest in many different companies all at once. Honestly, this is the absolute best choice for everyday people. You don't have to stress about picking one winning stock. Instead, you just own a tiny piece of the whole market. It is safe and it's simple. But what if you still feel like you need professional help? Author E.G. Doi suggests you ask one very direct question. I want to increase my money. Can you help me? It's that simple. A great advisor will give you a clear, easy-to-understand answer. A bad one? They will try to confuse you with a bunch of complex jargon. Always demand clear answers. Okay, Section 2. Winning the loser's game. What actually happens when your simple money enters the giant global market? Well, research by Yuji Kage offers a really clear picture of this. The hard truth is, the market is kind of an unfair game. Think about it. Strong investors, like the big banks, have huge funds and super fast information. Then there are the weak investors. That's everyday people like us. We have way less money and much slower information. To win anything, you first have to know your place in the game. Because we are the weak players, we have to use a totally different strategy to win. You simply cannot beat big banks at their own fast game. Instead, you win by playing a slow, safe game. This is exactly why those simple index funds work best for normal investors. You win by being patient. Moving on to Section 3. What makes companies strong? We just looked at everyday people. Now, let's zoom out a bit and look at the companies themselves. We have to ask a really big question here. Is a strong company just about a high stock price? A deep review by Nikki Business asked if financial returns are literally the only thing that matters. I mean, if a business makes a ton of money, does that make it truly strong? Well, the answer might actually surprise you. They found a totally different path to real success. Step 1, follow a basic philosophy. Step 2, contribute to society. And Step 3, enjoy long-term prosperity. It turns out, companies that genuinely care about society actually see their stock prices go up over time. Helping the world makes a company stronger, not weaker. It is a real win-win. Section 4, the growing wealth gap. So companies grow, but unfortunately not everyone wins when that happens. We really have to face the hard reality of the wealth gap. Let's consider Abenomics. These were Japanese economic policies designed to force rapid growth. But if you read the work of Thomas Piketty, he shows us a hidden risk. When policies focus only on moving fast and growing wealth, the rich often just get richer, while everyday workers get left behind. The gap between them just grows wider and wider. Author Yukio Noguchi points out another big flaw in the system. The modern finance industry focuses heavily on moving money around, and it often ignores vulnerable people. Meanwhile, the manufacturing industry, the people actually making real things, is losing its power to Wall Street. The whole system easily becomes blind to everyday struggles. This brings us to Section 5. Invest to fix society. This is the absolute crucial point. How do we actually fix this economic pain? How can we use our wealth to help? Look at this massive number, 24 million. Author Masayuki Nakagawa notes there are 24 million people living in poverty in Japan alone. That is a staggering number of people struggling right inside a very rich country. We absolutely cannot ignore them. So, what is the solution? Well, these people need real investment, not just charity. To truly help, we must invest in their future. We shouldn't just hand out free things. Instead, we have to build systems that teach skills and offer real chances for people to grow. That is what true social investment looks like. And this perfectly shows our learning journey. Think back. In 2011, we learned simple rules to protect our own personal money. Then, by 2013, we figure out how good companies can actually help society. And by 2016, we're focusing on national poverty. See the pattern? We start by managing our own wallets, but we finish by investing in our entire world. Which brings us to our final big question for today. Will you use your wealth just for yourself? Or will you use it to invest in a better society? Money is a powerful tool. Once you learn how to grow it safely, you have a choice to make. Keep learning, keep it simple, and always look at the big picture. Thanks so much for joining me for this explainer, and I'll see you next time.